All right, welcome to this week's 5 in 20, where we cover 5 topics in 20 minutes. We had to take a lot of notes, Brad. there were a lot of things we had to leave out for this 5 in 20. I think there's a lot of headlines out there that cover things well. These are more things that are more investment related and impacting potentially our portfolios. So let's start with number 1. This one keeps making the top 5, I've noticed, looking back at our history, but it's important, and that's inflation.
Yeah, it is. We've talked about this a little bit, which gives how important we think this is, and we should know about this when we're constructing portfolios for clients, and clients should understand what's happening in the marketplace relative to inflation. Now, in March, Consumer Price Index rose 2.6%. That's on a year-over-year basis, which is a little higher than it's been in the past. In February, it rose 1.7%, which is along with the last 12-year average of about 1.6%. So prices are rising, it appears, and that has an effect on what's happening in not only in clients' pocketbooks, because that's what we pay at the grocery store, or that's what we pay at the gas pump. It has an effect on how investors decide how much to pay for investments.
Yes.
So when you're looking at the rate of return, which is a futuristic, and you discount all those returns back to today, and you compare that relative to the rate of inflation, that has an effect on how the expectation of prices are in the stock market.
What I think is interesting is inflation. We used a 2.25% assumption in our planning, which we're going to have to start looking at as maybe we need to make some changes there in our planning assumptions. But the Fed has basically said we don't want rate. In the past, they've said we don't want a rate higher than 2%.
Right.
Now they're saying we want a 2% average. So that means you could have 1%, then you could have 5% for a year, and then you could have 6%, and then you could have 1%. But over time, they wanted to have an average 2%. So what that tells me is they're not going to put any governors on the economic engine. They're going to let it run as hot as possible. And then if they see that their average is below, when do they start the time on this? Because if you look way back, we could have a very large inflation now to get a 2% average.
Well, that is the concern of economists and investors, and that by the time the Fed puts these so-called governors on inflation, utilizing the tools that they have available to them, it could be too late. Inflation may have already gotten away from. Now, the Fed, of course, has 2 mandates. One is for stable prices, and 2 is for full employment. And right now, they're focused on employment. Coming out of the coronavirus pandemic and the economic shutdown that occurred afterwards, and the 20 million people that lost their job during this, they're focused on revving up the economy, getting these people back to work, and allowing inflation to go up perhaps a little higher than normal.
Right.
And they're couching it in this, we're going to take an average of inflation.
I just have I don't have a whole lot of faith that they can actually do things in the end, because do things correctly in the end. They're talking about, they realize that they have a hot running economy. They saw during the Trump administration, they had this hot economy. Minorities were employed. Employment was very low. Things were looking economically really good. And then we have the COVID crash, right? Yeah. So now they realize that when they go out and they're stopping inflation, they're doing the things that the Fed does, that they're actually hurting jobs for minorities. So now all of a sudden we have this whole nother play to their playbook that I don't think we've ever really have.
Yeah, this is new uncharted territory for them. It is without a doubt. They're really focused on getting employment back up to what is considered to be full employment.
Right.
And when that occurs, generally inflation kind of goes along with that because of the wage pressures that are put on employers in order to attract workers, which then, as higher wages come into the marketplace, higher prices kind of go along with that. So they're going to work these 2 ends of the seesaw, if you will, hopefully to a good end.
I mean, the last year, just going through a Wall Street Journal article, Apples are up 10 to 20%. Homes are up over 10%. Computer graphics card, which last year was $200, is now $1,000 for a computer graphics card. So there's a lot of things are going up. And labor, it's important to note that labor is being paid more to stay at home than what they were getting in their wages prior. We've talked about this several times.
Yes, we have. In fact, there's a new effort out there. Several states are decided to effectively cut off the subsidy for unemployment. They'll keep the state unemployment,
Right.
but cut off the federal portion of that. And so these should be little microcosms of an economy, and we'll see how those do relative to the rest of the United States economy and bringing employment back into the to the marketplace, we'll say.
Well, I think this is going to keep popping up on our top 5 going forward, so we'll save some time for that.
Yeah.
Let's talk about, there's an article in the Wall Street Journal a few days ago talking about the biggest mistakes people make with Social Security. I thought that was interesting.
Well, the Social Security is a decision that we are all going to make at some point in time. And unfortunately, it's a decision that is unique to every individual. Many people choose the same thing, but they choose it uniquely for them.
But as a general rule, though, I'd say that here, most people need to wait till 70 to take Social Security. And what's interesting is the emotion that goes into that, because people think that this is the number one mistake, was taking it too early. People think that they need to get paid back everything that they paid in, and therefore they need to take it right away.
Yes,
yeah,
start early.
That's the wrong approach to it. The correct approach, and this goes way more than the 4 minutes we can spend on this topic. But the correct approach is to look at it as insurance. Social Security is there to make sure you don't run out of money. And so if you if you take it at 62, which many people think I'm going to take it as soon as I can possibly take it. Mm-hmm. If you delay from 62 to the max age at 70, it's a minimum 78% increase in payment.
Right.
Right?
Right. Which then lasts for an entire lifespan.
Then it goes up by inflation after that. So whatever the inflation is, that's what Social Security will go up by. So that is your guarantee.
Right.
Right. You don't look at it as your home insurance as saying I want to get every single penny back out of my home insurance that I paid in.
Yeah.
You know, should my house blow up,
you have to wreck your house.
Right.
But essentially, people may be in a position where they're wrecking their portfolio. I'll use that analogy again.
Absolutely. But that was the number one reason, or number one look back. Also, there are situations where you should take it earlier. Disabled, widowed, or widower. So there are times when we need to be a little smarter about taking it early. But for the mass majority, you need to wait till 70.
You do. Yeah.
That's what it comes down to.
Yeah. Study after study after study is showing this. And people are beginning to respond. In the last several years, studies have shown that Social Security is being deferred longer than it was just 5 years ago.
That's right.
Yeah.
All right. How to spot a bubble.
Yeah, we have a story here. We have a story that goes back 300 years.
And I love this story. Tell me more about it. Tell me the story again. Tell me the story again.
It's like story time, because it's over and over and over, and it happens, and history just keeps repeating itself. This goes back 300 years when Europeans somehow, and I don't really understand how this occurred, but began to assign a value to tulip bulbs.
Yep.
And as I thought they were valuable, you thought they were more valuable. And somebody else thought they were even more valuable and more valuable. And it was a mania. It was the first recorded price mania for tulip bulbs. They grew flowers.
Makes sense.
But it just kept going and going and going until it stopped.
Yes.
Yes.
And when it stopped, people got hurt.
That's right. That's what a mania is. You have these price increases over and over, inflations, if you will, until somebody realizes, wait a minute, we're bidding up the price of a tulip bulb here.
Yeah. Yeah, that sounds a lot like a non-fungible token.
Non-fungible token.
We're bidding up a price of a house that doesn't actually exist. We just created it, and we look at it through 3D glasses, and we paid $500,000 for it. That sounds exactly what mania is.
Other manias were, we saw one in the Great Financial Crisis, 2007. Up to then, we were seeing a housing bubble.
Yep.
Okay.
Or the .com.
The .com in the late 1990s, where we were bidding up prices of internet companies that had no revenues whatsoever. They were all betting on the futuristic of it. One of the things that was interesting is that these manias in the financial business often are associated with a timeline where you have changes in the financial structure that's occurring. And what's occurring now? Cryptocurrency is somewhat of a change in our financial structure. And people are betting that it is going to become a major form of currency.
That's right. That's right.
So they're getting in early. Now, whether that occurs or not, we don't know.
Well, it was a very interesting article. I was reading it with intent, going, "Oh, what's the thesis on the bubble? Is this a bubble? Are we forming? Does the writer think we were in a bubble?" And then we get down to the end, and yeah, I don't know. Maybe it is. Maybe it isn't.
Yeah.
That was very disappointing.
Yeah.
I wanted an answer, dadgummit.
Yeah.
I found something encouraging in the article though. Loans, debt. So the government is taking on tons and tons and tons of debt. However, consumers are actually reducing credit card debt. Overall consumer debt, though, is actually increasing.
It's increased, but not at the same rate.
No, nothing like the rate we had in 2008.
Yes.
Nothing like past crisis. So
Right.
I think that's really encouraging.
It's very encouraging because consumer balance sheets
and
are
corporate
best,
balance sheets are better.
Are best that they've ever been, quite frankly.
So is this a bubble? I don't know. Will there be a bubble? Yes, there will be a bubble. And
when?
It's going to burst.
Don't know.
It's going to be ugly.
Yeah.
And that's when we're going to reinvest our dividends into lower priced stock. And we're going to come out the other side just like we did in all the other bubbles. Well, I wasn't alive for the tulip bubble, but can you shed any light on that?
Oh, I knew you were going to go there.
Sorry, Brad. I set you up for that. All right. So we don't know if there's a bubble or not, but there's a lot of new things coming out in innovation. And in the end, there will be a bubble, and we're going to get through it just fine.
That's right.
All right. The next topic is, I love this topic. I saw this email pop into my inbox from ETF.com, which I love their content. Their writers the last 6 months have been on their A game. Every morning I look up and there's my ETF.com article, and I'm like, oh, I gotta read that before I do anything else this morning. ESG funds don't outperform. I love it because
controversial.
I have been saying this the entire time. ESG primarily benefits BlackRock right now, and I think it's hogwash. I think the whole thing's hogwash. It sounds good. It sounds pretty, right?
It does. It's hard to say no to ESG because it sounds so good, as you said. But as an investor, we have to remain objective. We have to produce a quality portfolio that achieves our clients' objectives with the least amount of risk and the greatest amount of probability. ESG has been studied and studied and studied, but it has a very short period of time.
And that's environmental, social, and governance.
And governance.
That's what that means. We have a whole podcast on this.
Yes.
Go search for it.
Yeah, but it's been studied during a period where the factors involved in ESG have done well. A new study has come out, the one that's being talked about here in the ETF.com article, is that if you take out the factor analysis and leave in simply the ESG, those companies, as an index, as an ESG index, has not outperformed the general market.
Yeah, never
It's
has.
the factor
Probably never
involved with them that produces the return that is being reported.
Right.
We have a factor fund, Casey.
Yes, we do.
And it's the same factor that's being used in this analysis.
At half the cost.
It's a quality fund.
Yes. It's the whole thing. I just, it's so frustrating because the whole world is like, we have to have ESG, and you have to do a lot to get me off of an S&P 500 index fund that costs 0.003 or 3 basis points a year and trades for free on any major platform. You have to do a lot to get me off of that as a core investment, right? Active managers can't do it. We know this. We have data for that. 20 plus years. We have a 98% chance of outperforming any of those active managers, right? Then comes along ESG. Oh, we have to do this differently. We have to build it differently. I'm like, I don't know. I've seen this before. It was called low vol. The low volatility of the S&P 500. Oh, we have to do this low volatility thing. It was really big during the financial crisis. Now we roll forward. We have this ESG product. And in the end, I'll look at it and go, okay, what Fortune 500 company is not participating in anything that has to do with environmental improvement, social actions, right? And then the diversity of the governments of their board. Show me a S&P 500 company is not doing that.
That's right.
So I'm like,
they're all moving in this general direction.
They're all moving in that direction. So if you look at the S&P 500, okay, its MSCI ESG ranking is AAA. Well, if you buy the BlackRock large cap U.S. fund, it's only AA, one notch above. There's not a whole lot of difference between AAA and AA. It's not like it's single A, the best, right?
Right.
So I love academia. I wish I was smart enough to sit there and crunch every single one of those numbers, which it probably took them 6 months to do. And so I'm very grateful for articles like this that come out that say, hey, this stuff's flawed. Of course it is. You know, what it comes down to is that BlackRock looked at it as we have this corporate agenda, right? We want to boost our own stock by saying that we're ESG, right? And so, and oddly enough, some of them are in the White House now, so they're trying to, there's a conflict here. Now then they triple the price of their funds that are ESG. So now
the management fee.
They're making more money because prior to this, the management fee, there was downward pressure on the management fee, right?
Right.
Fees were coming down, unless you had a specialty. Then we get our specialty, and now we can charge 3 times. They can charge 3 times as much.
Well, they've created a preference amongst investors
and marketing.
then created the product to fulfill that need.
Yes, correct. And marketing does a great job. Any active managed marketing fund is going to go on a heavy marketing campaign when there's a good period of great performance. We've outperformed X, Y, Z in the last 3 years in this category. Well, yeah. Why would you tell me otherwise? Why would you say I've underperformed over the last 10 years?
Yes.
Or 5
and we've
years
built a fund to do it again.
Right. Exactly.
No.
So ESG, the concept or the funds had this kind of Goldilocks period where everything was just perfect, right?
Yeah.
And I don't see that in this calendar year happening right now. And so I think we're going to see more articles like this. And it doesn't mean I'm against ESG. I'm just against people telling me it's ESG and charging me a premium, and then I'm underperforming the S&P 500, which is ESG in itself, by itself, naturally.
There it is.
I'm very passionate about this.
I can tell. That's okay.
All right. Last topic. Tell me about earnings, Brad.
Earnings in the first quarter for 2021 have been spectacular, without a doubt. Okay?
That's great.
Now, you could say, you wouldn't, but you could say, well, what are they being compared against? First quarter of 2020 when COVID had hit.
Yeah.
Okay. But they're doing what we had hoped it to do in terms of the companies reporting their earnings. They are hitting it out of the ballpark. On average, the average earnings growth of the S&P companies that have reported so far, and I think 88% have reported so far, their earnings growth is 49.5% growth. 49.5% growth over first quarter of 2020. You say, well, the first quarter of 2020 was low. Okay, so fine, so be it. But they did it. That's the important thing. And in next quarter, the second quarter of 2021, they're expected to grow by 59%. Okay? Now, that's the growth rate. The actual earnings themselves, above estimates, they're reporting 22% above analyst estimate on actual earnings. Okay, that's fantastic. The leaders in the sectors, financial sector was the largest contributor to earnings in the past quarter. It's important for our economy for our financial sector to have strong earnings, because that is a huge part of the engine to our providing capital to other companies.
So really all those numbers support current stock prices, which is something that we're always looking at.
Exactly. And now the PE ratio is up around 21.5%, a little higher than the past 5-year average, a little higher than the past 10-year average, but we're in a new marketplace. The marketplace is flooded with money right now, with all the stimulus that's been placed into the marketplace. So it can support these higher multiples So
Right.
this is not an immediate concern that we have at this point in time, but it is something, like you said, that we keep an eye on. And as long as it's being supported by strong earnings growth and strong earnings, we'll continue to live within that range.
I like strong earnings. What I really just want is my countertops installed to this new space and the furniture to arrive.
I want a new propeller for my boat. I've been waiting for months, but there's no steel. The steel that's out there is being used for higher purpose right now than a new propeller, I suppose. I mean, they're getting to it before I am.
There's nothing more higher purpose than a weekend boating expedition.
Fortunately, I have a propeller. I just want a new one. But this goes back to inflation as well. It's all tied together. When there's a limited supply, prices go up as people bid for that product. So the supply chain, I think it was talked about in last week's 5 and 20, is a little bit clogged up right now. Hoping to see that, get pushed through. Adding employees to the job market will help. So,
all right, Brad, that's our 20 minutes. Enjoyed it.
It's a good day.
Time.